Good evening, everybody. Welcome to the August edition of Monthly Market Insight. As you know, every month we conduct this webinar where we have a discussion on the equity markets, events that are happening in the markets, what's happening to earnings, what's happening to valuations. It's also a good opportunity for us to take your questions. Many of you have already sent in some of your questions, which we'll be taking as part of our presentation. And of course, you can continue to send in your questions. We've also got on this call today Karthikraj, who manages UTI Mastershare and UTI MNC. We are going to be discussing Mastershare today. And we've also got on this call Niranjan from our product team, and he's going to be the one who will be taking the questions. And he's also helped put together the presentation, and he'll be sharing those slides on the screen. So without any further ado, we'll get underway today with this edition of the Equity Market Insight. So when we kick off, we've first got a few big picture charts to share with you, which will sort of put in context the kind of global environment that we are dealing with today. So the chart of the month is really about monetary tightening. So when you look at this chart, what you can see here are the plots of the RBI repo rate, ECB's, that is the European Central Bank's deposit facility rate, the US Fed funds rate, and the Bank of England policy rate. And as you can see over there, in 2020, all the banks, including India, cut their rates very dramatically. And then starting from early 22, all of them start to take their rates up. Of course, India also, we have seen an effective policy rate hike now of over 300 basis points. But in fact, in developed economies like the US, you have actually seen rate hikes of to the more than 500 basis points, which is why if you look at that black line and the other two lines, they have really gone up very, very dramatically. And the ECB, of course, moving up from negative territory to positive territory. Now, the thing to remember is that these rate hikes have been happening now over the last 15 months. But what we know is that monetary policy decisions impact the economy with a time lag. This is true both when rates are taken up as well as when rates are taken down. The economy does not immediately react to the rate increase or the rate decrease. There is always a time lag between the point of increase or decrease and the response in the economy. What we also know from a lot of historical research is this time lag is uncertain. It can be as early as 6 months. It can be as long as 18 to 24 months for the impact of those rate hikes to transmit into the economy. So the fact that these rate hikes have happened clouds the near-term growth outlook in the world and in India as well. And even though current readings of growth are quite strong, we have to worry about the lag impact, and therefore the impact of, let's say, Fed rate hike being well above 3% for most of this year is something that the impact in the real economy may show up only sometime next year. So that's the impact of the lag, and that is what keeps the sort of outlook into 2024 slightly uncertain. Moving on to the next slide. What we've got here is the fastest ever recovery from a recession in US nominal GDP growth rate since World War II. So you can look at this chart. It shows you the fastest nominal GDP growth that has happened in the US economy at different points of time. And since 2020, the recovery in US nominal growth is to the tune of almost 37%. This matches or is only bettered by the period of 1949 to 52, when the recovery was about 40% over a 3-year period. Now we've seen a 37% recovery over a 3-year period. Now, the reason that this has been so phenomenal is because the US has thrown in both a very significant fiscal response as well as a very significant monetary response. In fact, if you want to look for a comparison, look at what happened just in the previous incident sprint, which is 2009 to 2019. Remember, this is a 10-year period. This is a 10-year period when the US went through multiple rounds of quantitative easing, and yet they could only get a 13% increase in nominal GDP growth during this period. As compared to that, in a 3-year period, they could get 37% growth. Now, that's not to say that this is necessarily a good thing. It just means that this time around, they have thrown significant monetary and fiscal impulse into the economy, whereas after the GFC, they gave fiscal aid only for 1 year, and after that, the only game in town was monetary policy. So this massive increase that we have seen in GDP over the last 3 years is a function of a never before seen positive impact of both fiscal and monetary policy. But what does it mean now? What is the Fed likely to do? What is the expectation? That's on the next slide. And you can see 3 different lines over here. I'll first point you to the line which is at the top, which has those sort of big round circles in it, the blue dotted line with blue circles. This is really the current guidance of the FOMC. Actually, this is a combination of the different expectations of the different governors on the US Federal Reserve. So they still expect one more potential rate hike, and then a very gradual decrease in rates, starting in 24 and 25. Compared to that, if you look at the market, which is the slightly, sort of a mild blue line, which has got, blue squares in it, that is the market expectation. So the market really expects a much more significant drawdown in rates as compared to what the Fed is talking about. So this is the gap between the market implied rate and the FOMC. Of course, the final simple dotted line, more or less in black, that you see is the forecast of Jeffries economics team. They expect a much sharper decline in policy rates, in fact, starting in 2023 itself, and not necessarily waiting for 24. But I would really point to the gap between the light blue line and the darker blue line. This is an unusual gap where the market is expecting a much more rapid decline in rates as compared to the FOMC. And there is a risk over here. There is a risk from the FOMC's dot plots being higher. This means that the economy is likely to feel the prolonged impact of higher rates. So there is a risk from rates being higher. And secondly, that means there is some mispricing happening in the market because the market is expecting a cut in rates, and this poses a risk to the market. So this is sort of the global picture I wanted to share with you. It's one of rates being higher for longer, and therefore the impact on that might show up only with a time lag. But again, when we come to a summary conclusion slide, we'll talk about some of these factors. Very quickly, let's look at some of the economic trends. I'm not going to talk you through this, but I'll just leave it over here for a minute. And of course, these presentations are made available on our website, so you can see it later. The current consensus expectation from economists is 6.1% GDP growth for FY24. Remember, the government is talking about 6.5% to 7%. Most economists are expecting growth to be slightly weaker, partly because of the global factors being not very supportive. As far as inflation is concerned, the forecast is for 5% inflation all the way through FY24. But I'll just point out that given recent trends in food prices, there is increasingly the likelihood that the next few prints of CPI, the aggregate CPI, are likely to be well outside the 6% zone, though core itself might not change too much. And, that gives a fair degree of comfort. So moving on, this is the next slide, has high frequency indicators. I'm not going to talk about it this time, nothing much to mention here. We'll just move ahead to the next slide. Next series of slides, this talk about equity markets and valuations, what's been happening to markets and sectors. So this is the big picture. 1 month and 3 months, the biggest rally has been in the Nifty small cap index, up about 8% over the last 1 month, up nearly 21% over 3 months. And therefore, on a 1 year basis, it's now up about 27%. if you look at the sectoral indices below, you can see over there that over the last 1 year, it's the Nifty PSU Bank which has been the best performer. But recently, as RBI went into pause mode, the Nifty Real Estate Index has done quite well, and now even on a 1 year basis, it is quite strong performer. Two of the sectors that we've been talking about, one is if you look at auto has been a very consistent performer through this year. It's among the best performing sectors on a 1 year basis. And gratifyingly, because I know in many of these calls, I've always talked about pharma healthcare being a bit of a contrarian pick for us. So happy to see that, both on a 1 month and 3 month basis, there's been a sharp improvement in the performance of the Nifty Pharma Index that you see here. And therefore, even on a 1 year basis now, it's really caught up with terms of performance as compared to being a laggard. And, I kept talking about this as a contrarian pick over the last 3 to 6 months, in fact, going back a year. So the recent strong performance has certainly lifted the performance of this sector now, both on a short-term basis as well as over a 1 year basis. Moving on from that, if you look at India's performance in a global context, I'll just point to one chart, which is actually the 1 year chart, and I think that's interesting. While India has done well, it's actually in the middle of the pack in a global context on a 1 year basis. And while we don't have a year-to-date chart over here, on a year-to-date basis as well, which is calendar year-to-date 2023, India is actually in the middle of the pack. Markets like, developed markets like US, Germany, Japan have actually done better year-to-date, and even emerging markets like Brazil, and Korea have done much better year to date. So year to date, actually, market performance has been very, very strong. India has actually been more of a low beta market. We outperformed on the way down. So in 21-22, when markets were selling off, we came down much less. And as it has turned out that US economy and the European economy have not been as badly impacted as people were expecting, most equity markets have seen a bid. And in that rally, which is essentially happening for cyclical reasons, India has underperformed on the way up. So I think that's a reflection of a low beta market where more investors are focused on the structural story and not really on the cyclical story. So when the global growth cycle has been seen as negative, many of the developed markets and emerging markets sold off, India outperformed. And when the view changed that maybe things are not going to be so bad for the global economy, those same beaten down markets have actually outperformed, and India has just sort of kept pace with the move. So that's sort of the story from global markets. But let's just now move on to the next few slides. Now, if you look at earnings growth forecast for March 24, it's now about 17%. I should point out that about 2 or 3 months ago, this expectation was closer to 20% plus. But as we've been saying, given the headwinds, we do think there is some downside to the earnings estimates. Earnings, as I'll come back to later, have been cut by about 1.5% over the last 3 months, and now the growth expectation for 24 is about 17%. Moving on to talking about these trends, you can see them here. Just look at that middle set of bars. In March 23, the expectation was that Nifty 50 EPS for March 24 would be 992. Now that estimate has dropped to 977, which is a cut of about 1.5%. Similarly, FY25 estimates have also been cut by about 2.5%. So there is a broad cutting of consensus growth expectations, which is happening. Moving on to the next slide, where are we in terms of valuations? The last 3 months have been very good for Indian markets. In fact, the last 4 months. As a result of that, if you look at the right-hand side chart, the Nifty 50 forward P, you can see that after coming to sort of halfway between the long-term average and the expensive zone, it's actually bounced back slightly into the expensive zone again. On the next slide, we can look at price to book. Again, there has been a bounce back, but on a price to book basis, the market is still in the fair value zone. It's not entered the expensive zone. What do valuations look like for the mid caps and small caps? We can see that on the next slide. The mid caps have also done spectacularly well in the recent months, and therefore they've actually pulled up on a price to book basis into expensive territory. Small caps remain quite expensive. So this is the picture from valuations. Large caps in the comfort zone, mid caps pushing slightly outside comfort zone, both above the long term average, small caps looking expensive. Moving on to the next slide. This is where we compare equities versus bonds. Remember that this equation had moved in favor of equities by March 23, but given the recent rally in equities, that purple line has started to move down again. The current yield difference is about 1.95% vis-a-vis 1%, which is the long-term average. And to that extent, actually, now the argument is more favorable towards fixed income than it is towards equities as a tactical indicator. I'll move on now to the summary slide. This we've already talked about. So yeah, we'll just go to the summary slide. The Fed hiked its rates by about 25 basis points in July to 5.5%. So almost a 550 basis point increase over the last 15 months. They've highlighted that the policy remains data dependent and the market is divided that there could be another hike in long-term rates, in the policy rate. But I think the most interesting thing in the last 2 weeks has been the sharp spike up in long-term bond yields. So the US bond yields have really spiked at the long-term end to above 4%. Partly this reflects concern about the Fed policy, but equally it's a reflection of the fact that the US Treasury has now indicated that it intends to borrow more money at the long end of the curve. So it's both a demand and supply factor which are causing the long bond to spike higher. US economic data remains robust. Inflation is declining, but remains well above the 2% target. I should just add over here, and those of you who've been following our presentation over time would remember that for many months we used to show this probability of US recession. Now, the Bloomberg probability of US recession is still 60%. It's been in the 60 to 70% range. So economists expecting a recession in the next few quarters, that number still remains at about 60%. But recently, if you look at some of the commentary, Treasury Secretary Yellen was in fact in India last month. She actually said during her visit to India that she no longer expects a recession in the US. And that's simply because US economic data has been so robust. Now, if you remember my first chart, the challenge with this is the lag between monetary policy decisions and when it impacts the economy. So the window is fairly wide in terms of whether we see it impacting the economy. But the fact is that the economy has already surprised us by not going into a recession. And that is the reality that Treasury Secretary Yellen is talking about. In India, the MPC will announce its decision tomorrow, widely expected to remain in pause mode, even though, as I said, it's very likely the next few prints of inflation will push above the 6% mark, simply because that's going to come from a spike in food inflation, even though most other, core inflation still appears to be in the same 5% trajectory. But my gut feel is that in the short term, RBI will be guided by core inflation. But of course, we'll know their commentary tomorrow. Q1 FY24 earnings, the earnings season is not over, still another, about a week to go. But so far, earnings have more or less come in line with expectations. Revenue growth has been very weak, but it's weak for a statistical reason. Remember, in the base quarter last year, commodity prices were elevated. They've come off quite sharply since then. So both for commodity companies as well as for companies where commodity prices are a pass-through, there's been a deceleration in revenue growth, but margins have expanded. So EBITDA growth and profit growth have been very healthy. Having said that, we still continue to believe that there is downside risk to FY24 estimates. As I said earlier, they've been cut by about 1.5% in the last few months, and we still think there is potential for some more cuts in the months ahead, simply because of the sort of more difficult global operating environment because of monetary policy. Equity valuations somewhere in the comfort zone, but well above the long-term average. Those of you who have been following us over the the last month as we've talked about our launch of the Balanced Advantage Fund. We are very thankful to investors. Our collections are close to 2,400 crores. We talked about our model that we use in the Balanced Advantage Fund, which looks at PE, price to book, dividend yield, and a comparison of earnings yield to bond yield. And that market that indicator is currently indicating a very neutral positioning to equity at a 60% allocation. So which is why we say equity is sort of in the comfort zone, but not really very bullish, extremely bullish, because valuations are above the long-term average. And that's why we would say, if you're going to invest lump sum, look at products like the Balanced Advantage or the multi-asset fund, where we are anyway taking the asset allocation decision. But otherwise, do continue to adopt a staggered approach towards equities, because valuations are not in the green zone. So that's about it from my side in terms of laying the big picture for today's conversation. But I'm going to hand over now to my colleague Karthikraj. He's going to talk about UTI Mastershare, and then in the final 20 minutes, we'll take your questions, some which have already come through, and the rest which you can continue to send us. Over to you, Karthik.
Thanks, Vetri. Good evening, everyone. So I'll be talking about Mastershare, which, as all of you would know, is a large cap fund. The strategy here is of identifying companies with competitive advantage. We follow growth at reasonable price, or GARP as it is called, the growth at reasonable price philosophy. And from a concentration perspective, typically the fund has around 50 odd stocks, while the broad range is 40 to 60. The average is closer to 50. That's how the composition is. And being a pure equity category, it is considered as high risk and high reward. The benchmark is BSE 100. If you go to the next slide, the question that arises is, why large cap for wealth creation? The simple answer is, even from a market capitalization perspective, close to 65-70% lies in the large cap companies, or the top 100 companies by market capitalization. Even from a wealth creation perspective, that would be true if we take the last 10-20 years. So that's where a significant proportion of the wealth has been created in large caps, and that's where it makes sense for a equity investor to have sizable exposure here. And that's why we categorize large cap as core part of anyone's equity holding. Some of the advantages of large cap clearly is many of these companies are leaders in their category. And to that extent, they have advantages of scale, they have a strong brand, and often many of these companies have seen many cycles. And through the cycles, they've learned, and their balance sheets have become stronger, and they are well adapted to any of the cycles. So that way, the large companies have significant advantage of reach, brand, scale, experience, and so on, which comes to the help whenever the macro situation is challenging. If we go to the next slide. So if we look at the market share of many of these companies, the large companies, whether it is banks or cement or passenger vehicles or domestic pharma, telecom, what we've seen is in the last 10-12 years, the large companies have actually seen market share increase. So banks, for example, FY10, the top 6 banks market share would have been around 47%. That's gone up to as much as 61.8 by FY23. And if we take passenger vehicles, again, the 83 odd in FY10 has moved to 86. Telecom, again, 65 has moved to 90, where we've seen a significant concentration. Cement, again, while it is supposed to be a fragmented industry, over the last 10-12 years, what we've seen is the large have got larger, and that's where the market shares have gained. Just trying to bring home the point that some of these large companies have a significant advantage, and they've used that to kind of gain market share. So they've grown faster than the industry, and many of these industries itself have grown faster than the GDP. So that way they've stood to benefit. Going to the next slide. So just at Mastershare, like I said, the key differentiation for the fund is we look at competitive franchises. So while within large caps, what we try to identify is companies which have some sort of competitive advantage. It could be in the nature of, say, a strong brand or a distribution reach, or lower cost of operations, or a network effect, or switching cost, or a technology advantage that the company might have. So some of these advantages actually help them through the tough times, and they actually gain market share during such phase, and eventually their growth and profit outcomes are much better than the industry. So that's where our focus is on competitive advantage. While like I mentioned, the idea is growth at reasonable price so that we have that margin of safety, but at the same time the significant focus is on the competitive advantage of the companies. And we do take the growth oriented companies and some turnaround opportunities, but even in turnaround opportunities, what we look at it is the competitive advantage that the company possesses. Going to the next slide, just taking you through some of the examples of the companies that we own in our portfolio, and what would be the competitive advantage. So here is a large company, a large private sector bank, which has grown over the last 25 years. Like clockwork, with 30+% advanced growth and profit growth. What has helped this bank is clearly the low cost of funds, which is the raw material for a banking business, as well as the strong underwriting process that the bank has followed through its existence. Going to the next slide. So this is again another private sector bank, but this too had a low cost of funds advantage, but somehow they had asset quality issues. But we saw that turning around in 2018, and that is where we captured it as a turnaround opportunity, because the core competitive advantage was in place. There was a missing piece of proper underwriting or a lower credit cost. When that got solved, we kind of increased exposure here, and that is kind of helped us. Going to some of the other examples, non-banking examples. If we look at passenger vehicle, the number one company has more than double kind of a market share, and that has helped them in profit margins and the cash flows. So they've been better off even in a down cycle for auto industry, and they've come out stronger. And similarly, talking about a large value retailer, here again, their significant advantage is the lowest cost of operations that they run through. So while their gross margins are very low because they want to pass on the maximum benefits to the customer, but at the same time, because of their low cost of operations, they do make significant EBITDA margins, and that reflects in better ROCs for the business. Going to the next slide. Again, on the general insurance side, again, the leading private sector company has a very strong underwriting process, and that has helped it have lower combined ratios. Combined ratios, as you know, is the losses plus the expense, both of them put together. So lower the better. So it has had always lower combined ratios than the industry, and that is reflected in superior ROEs or profits for the company compared to the private sector or the overall general insurance industry itself. So this profit pool has helped the company slowly gain market share over the last decade and fortify their position. Going to next slide. Again, some more examples on the IT and pharma. IT, again, it is people's business where the lakhs of employees are employed, and there the scale itself is an advantage for the large companies. So they have significant margin gap with the rest of the pack. So almost 10% plus kind of margin gap with the rest of the pack because of their scale and client relationships. And again, going to pharma, while we know the generics business has gone through huge price erosion in the last 10 odd years, a company which is focused on a specialty pharma where the pricing discipline is far better, has come out better in terms of the cost pressures, and that has helped the company's profit growth. Going to the last slide for examples on competitive advantage. Again, paints, as we know, I mean, it's supposed to be a chemicals business, but in India, it is as good as consumer business, where the company's brand image come to the fore, and their ability to kind of keep the channel engaged and kind of distribute the products well in time has helped them, and that is where they've had significant margin expansion over the last 2 decades. And telecom, as all of us know, it's a classic case of consolidation and the last man standing, where from 10 plus players, we've come to probably a 3 odd player market, and the last few companies which are standing are reaping the benefits of ARPU increases. So all of these are portfolio companies, and all of them have some competitive advantage, which has helped them grow profitably over the last few years. And that's what Mastershare stands for clearly, identifying companies with strong competitive advantage. Going to the next slide. What these what is the result of this competitive advantage portfolio is that on the way down, the fund tends to outperform. So we've taken last 20 years instances where the markets have seen a drawdown of more than 20%. There have been 7 instances, and each of the instance, the fund has fallen less than the benchmark and created alpha on the way down. And if we see the last 2 columns, the next 3 years or 5 years after the drawdown, needless to say, the returns have been quite good, anywhere from 50% on a 3-year basis to almost 150% on a 5-year basis. So from an investor perspective, all the more important that during a drawdown, one should not get tempted to kind of get out of the market, but rather stay invested, because the subsequent period is quite rewarding. Going to the next slide. This is the current portfolio of Mastershare. On the left-hand side, you see the top 20 stocks, close to 70% weight in the top 20 stocks. But the active weight in most of the cases is positive, just to show that wherever the companies that we like, we have sizable bets there, and we have active position or a positive active position. So that's where, while it is a diversified fund, we do take conviction bets wherever we have the strong conviction. And on the right hand side, we have the mid and small caps, which are the non-benchmark names. But many of these companies are structural and probably leaders in their particular sectors. For example, beer company, bearings company, tire exporter, auto ancillary, and so on. So many of these companies are part of the portfolio for a long term because they have some competitive advantage, and often they are leaders in their category, and they have high growth. And we believe some of them could eventually be large caps as well. And to that extent, we would be able to create some alpha there. So typically the non-benchmark, that is the mid and small caps exposure, is in the range of 10 to 15%. So at this point in time, it is closer to 10 odd percent here. Going to the next slide on the sectors. So at this point in time, again, we are significantly positive on the private sector banks. They've gone through market share gain over the last 2 decades, and we believe that is likely to continue. The top 4 or 5 private banks are likely to continue to gain market share. So we have a classic case of the private banks growing faster than the banking industry, and probably the banking industry itself growing faster than the GDP. So we continue to have our overweight exposure in the private banks. The next one is IT, where in the last few months we've from underweight we've gone overweight because we believe the excess as far as the valuations are concerned are more or less taken out. We've seen absolute price correction in the last year and a half, as well as a kind of a time correction when the earnings have grown. So to that extent, the valuations are no more expensive here. And as we know, this sector has created a lot of wealth. We have good corporate governance, healthy cash flows, return ratios, and so on. And the medium to long term potential for this sector still remains intact. Again, autos, we continue to be overweight, but there is a difference in the story. The last year was about the volume rebound after the COVID period, while the current year is more of margin expansion, which even Vetri talked about. The commodity prices have come off, and to that extent, there has been some amount of margin benefit that is visible for many of these companies. While volume growth might still continue, but part of it is already captured in the base in FY23. Within consumer, again, what we like is more the discretionary or the durables bit, and we are underweight the FMCG because while both of these categories are expensive, the growth profile for consumer discretionary or the durable seems much higher compared to the pure staples or FMCG. Where we are underweight is clearly, other than FMCG, it is energy and metals and mining and chemicals. These are the sectors where we are underweight because partly the valuations have caught up post-COVID, and even from a growth perspective, the prospects in the next 1 or 2 years looks more challenging. So to that extent, we are more positive on the private banks, IT, selectively industrials, and healthcare, like Vetri mentioned, where we have had a contra call, and that clearly seems to be working. Going to the next slide. Yeah, this is the wealth creation journey. As many of you know, I mean, Mastershare is one of the oldest fund with close to 37 years of history, where we've just recreated that. If it was, I mean, it was made as a growth option only in 2005, but if it was all the money dividends were reinvested, how would the 10 lakhs look now, and how would it look if it was invested in the index, just to show the alpha creation over the longer period of time. And going to the next slide on this. Investment strategies on the equity side, we have the entire bouquet. I mean, right from diversified funds to thematic funds and sectoral funds, and even the passive index and ETFs. So we have the entire bouquet here. With that, I'll stop, and Niranjan, over to you.
Yeah, thanks a lot, Karthikraj, for a detailed overview on UTI Mastershare Unit Scheme. And yeah, so now we will start taking the questions which have come our way. So request to participants, keep posting your questions on the chat box. So we will take as many as possible over the next 15-20 minutes. So here is the first question to you, Karthikraj. There is a lot of discussion lately on the actively managed large cap funds on their ability of generating alpha, right? So, and what the question is, what is actually causing the unfavorable divergence in the performance in the recent time, especially in the last 1 to 2 years? And also, if you can throw some light on the broader performance attributes which is actually causing the divergence.
Yeah, right. So as far as Mastershare is concerned, while we look at GARP, I mean, it's predominantly the high growth and quality portfolio. And last couple of years, the quality and growth as a style has been little out of flavor, and that's where we've had some bit of underperformance. And if we take a 5-year period, what the other significant factor is, I mean, the passive funds AUM has from almost negligent levels moved up to a significant significant proportion of mutual fund industry itself. So what this passive fund AUMs have done is it's gone into all the stocks in the index, and wherever active funds like ours were underweight, even there's been money flowing in, and some of them have outperformed, and there has been a lag, especially in 2018. It was handful of stocks which outperformed, partially maybe because of these passive funds, and there was some amount of gap that was created. From a 5-year perspective, maybe that was one event, but in the last 2 years, it's more of the growth or the quality style being out of flavor, where Mastershare especially, we've seen some underperformance. But we clearly believe that the style does come back, and when we have the quality portfolio and the earnings growth is there, I mean, the stock prices eventually follow. I mean, stock prices are slave to earnings. So if the earnings growth is there, eventually there's a lead lag, and we would see the performance coming back. And even in a category like large cap, there is scope for alpha. One, through the stock selection within the top 100 names itself. And other than that, there is room for, say, a 10-15% exposure to mid and small companies. Some of them could be growing faster, and to that extent create alpha. So we still believe from a longer term perspective there is potential, and our strategy is well poised. But the last 2 years, clearly the growth and quality strategy is not performed to our expectations.
Sure, Karthik. Thanks for that. The key message is having conviction and long-term orientation is key for wealth creation. Thanks for that. And I'll take the next question to Vetri. Vetri, here is a question on the US Fed. Fed has actually left the door open for another rate hike basis the evolving data on inflation and labor market. So, however, does the magnitude of policy tightening makes hard landing for unavoidable for the US economy? So, what is your thoughts on the same?
Yeah, Niranjan, as we showed in some of the earlier slides, the policy rate tightening has been quite significant. But as I also said, so far actually there is no sign of any recession, so to speak, hitting the US. If anything, Treasury Secretary Yellen said she no longer expects a recession in the US. So that's the thought process of the senior most Treasury official in the US government. Having said that, it's certainly not a zero probability, and it's not a zero probability for the reason that I said, monetary policy works with a lag. And the second thing that you need to remember is that sometimes it can also be a policy mistake which triggers, a recession. So it's not a zero probability. But so far, I must say that the prospects of the likelihood of a hard landing are actually looking quite low. And one has to sort of agree with what the Treasury Secretary is saying, that there is no visibility of a recession as of now.
Sure. Thanks, Vetri. So there is a similar question from domestic India point of view. So while the central banks here expect the monetary conditions to remain tight for the time being, so is focused on the withdrawal of accommodation to ensure the inflation progressively aligns with the target of supporting the growth. So, however, are there any upside risk to the inflation expected due to the geopolitical tension or even the because of the international commodity prices?
No, of course, I think geopolitical risks are always there, and geopolitical risks, however, can come in both directions. So you can never say no to geopolitical. That's the very definition of geopolitical. But I think the more practical problem that is there right now appears to be more related to food prices, both because of, the very strong, initially some unexpected rainfall followed by very strong rainfall seems to have impacted some of the food prices. So I think the CPI print itself is going to come in outside the RBI's comfort zone. But my gut feel is that RBI has some tolerance in the sense that they will perhaps look through the headline number at the core number and choose to be slightly, sort of neutral at this point of time rather than react to inflation being outside the comfort zone with a rate hike, because they know that this sort of weather-related issue in food prices beyond a point cannot be tackled by rates. It's only when they think that this is now getting embedded in the system, I think, will they actually react to the core as well as the headline number.
Yeah, sure, Vetri. Thanks. There is one question coming from Mr. Dawal Shah. So his question is, while the recession in US cannot be ruled out, and while the things here again dependent on the inflation number. So what is your thoughts in terms of the impact of the sentiments of what's happening at the US level versus here in India?
Sure. So actually, I would say that because the markets are no longer perceiving risk of a US recession, is why you have had such a big rally in global risk assets year to date. As I said, India may be up just about 10% for the year, but look at the number of global markets, including the US market, which are up 20%. And the Nasdaq is up close to 40%. So it has been a full risk-on rally year to date across the world, simply because people moved from US recession to it's no longer clear to us that US is going into a recession. So I would actually argue that financial market sentiment is now, somewhere between neutral to becoming positive, that there is no recession. Sentiment is not dampened in that extent. As far as India is concerned, I think it's a more structural story over here rather than a cyclical story, and that is what is underpinning the prospects here. So, to my mind, the base case as of now is no US recession, very low probability of a US hard landing. I think what we have to worry about is that can there be an accident, right? Let me just explain. So now rates have moved up from 0 to 6%. Can somebody in the economy get badly destabilized because of this? What the data is telling us is that household balance sheets, because they built up such a massive surplus, both because of not spending as well as because of fiscal transfers during the period of the pandemic, they are still in extremely good shape, right? So households have not been impacted. Then you look at businesses. What about businesses? Interest payments of US non-financial corporates as a percentage of their profits or relative to GDP is pretty much at a 20-year low, right? So your households are currently in very good financial shape, not getting affected by the high rates. Your non-financial sector is not impacted because their interest cost as a percentage of their profitability is very, very low. They have also deleveraged. The sector which is actually carrying the interest rate risk is the banks, right? Because the banks are the ones which have now gotten stuck. Even if you look at your SVB episode, which happened in March, it was an episode related to a asset liability mismatch, where when the rates up, your securities were very good. They're all sovereign, but the mark-to-market value of that drops because rates have gone up. So I think the most vulnerable part of the global economic system or the financial system today is the banks, right? Because they are the ones who are carrying this mismatch in their balance sheets. Any accident which happens there can have ramifications for the US, which then transmit elsewhere. Finally, there is one additional constituent in this, which is government. Now, government and the US Federal Reserve are badly impacted by the rates going up because, they have borrowed lots of money, and the cost of that money has now gone up tremendously from 0 to 6%, and they will continuously, their interest liability will keep climbing in the years ahead. But, the sovereign is typically in a reasonably good place, and as long as the US dollar, despite all its problem, remains the most favored global currency, they are continuing to benefit from it. So I would say it is the US sovereign where longer term risk, but nothing short term. The unexpected risk to sentiment can come from the US banking system.
Thanks a lot, Vetri, for that insight. I will take this question to Karthikraj, which is on Mastershare. Karthik, the active share of UTI Mastershare Unit Scheme is about 40%, which is actually indicating the fund's relative biasness to investing in stocks with high conviction. So, what has been the fund's past trend in this regard, and would you be increasing the active bets in the fund further from here on?
Yeah, Niranjan, active is one way to clearly create alpha, and the active share has generally been around 40-45% here, and we would continue to have that kind of exposure or even higher if there is opportunity. But it's not necessarily the way that we work for an active share. It's far more, like I mentioned, identifying the companies or franchises with competitive advantage, and if that happens to be a lot higher in mid and small caps, most of them count as I mean the entire pack counts as active share. And even within the large cap, if there are some high conviction bets, that also create some active share. So the way is far more bottom up, companies with strong competitive advantage and enough margin of safety. That's how we end up building the portfolio. But on a construct basis, the active share remains at 40-45 kind of a range.
Sure, Karthik,
So
thanks for
just to
that.
add over there, Niranjan, I
Yeah,
think just
sure.
keep in mind that the the requirement for large cap funds is to keep 80% invested in large cap companies, and those same companies are part of your benchmark. So if you
Right,
look at
right.
the large cap category as a whole, active shares will be typically much lower than what they are in some other categories because of the way the structure of those funds itself is described.
Absolutely. Yeah. Thanks for that. There are a couple of comments on the performance of UTI FlexiCap Fund. So the current regime of high inflation and high interest rates is actually hurting the growth of the growth stocks with high valuations, right? So and also their ability of generating sustained cash flows gets relatively unattractive, right? So what is the philosophy which is adopted at UTI at the portfolio construction level, at the growth spectrum of funds that we have, and also what is the and the value spectrum of stocks that we have. So and also which portfolio style would you recommend investors at this point in time? This is a question comes from a couple of investors such as Mukundan and Krishnamurthy.
Sure. So, as we've said before, look, each of the portfolios at UTI is run with a very distinct sort of approach and philosophy. At the one end, you have something like UTI FlexiCap, which is run with a quality growth philosophy. And at the other end, you have something like UTI Core Equity, which is run with a very traditional value approach. Something like Value Opportunities is run with a value tilt. And something like Mastershare is more, growth, but maybe more at a reasonable price as compared to FlexiCap. So if you look at the last 2 years, it's been an environment which has been far more favorable to value as compared to growth. But just 2-3 points I want to make. We don't try and change the philosophy of the fund based on what the market season is. Market seasons will keep coming and going. Our belief is that as long as when the market season is favorable, we can create enough alpha during that favorable period, we will be able to, absorb the hits that we have to take from the market when the season is unfavorable. I remember a conversation 3 years ago where we were discussing that value has not worked in the previous 3 years, and then today I look at the data, something like core equity has outperformed massively as compared to a quality growth strategy over the last 3 years. But our approach is to stay the course with a particular style, because once you start looking longer term, 5 years, 7 years, 10 years, you will find that whether it is quality growth or value, both are capable of creating value for the investors in terms of alpha, but their seasons of performance may keep fluctuating. So the way for investors to make use of this is to look for diversification between different styles as well. One final word, Niranjan, if I actually look at the data year to date, right? So I'm talking about December 31, Jan 23 to today. Actually, the market is no longer indicating a distinct preference for value or growth. It's actually been very similar. If I look at quality and look at value, the performance has been broadly similar. The only market factors which have given very strong performance has been size. So small caps have done very well, mid caps have done very well as compared to large cap. But on fundamental factors, quality versus value, there is not much difference between the factors year to date. And I think it is suggestive of something that I have said earlier in this conversation as well, that when rates are low and commodity prices spike up, it's typically very favorable for some of the businesses which tend to figure more in the value bucket. But today we have already moved to an environment in which there are concerns about growth, commodity prices are no longer buoyant, and at the same time, cost of capital has moved higher. Now, in this kind of an environment, there is a newfound respect for companies that can get a healthy return on capital as compared to cost of capital, which may not be available in some of the traditional value seeking sectors of the market, which is why year to date I think the quality and value outcomes are more sort of even stevens, but I do think the baton sort of tilts towards growth as we go through the rest of the year.
Sure, Vetri. There is one question coming from Dr. Neeraj Singh. His question is on small cap funds. So while the small cap continue to trade at expensive valuation, the earnings expectation for some of the stocks continues to be very healthy, right? So what is your thoughts on tackling the expected volatility from this segment of stocks?
No, so we don't try to change portfolio strategy because of expectations of heightened or lower volatility. Our thought process for all our strategies, including our small cap strategy, is that we continue to run the strategy true to mandate based on the philosophy linked to the UTI investment process, which is core alpha. So we would not try to restructure the portfolio to reduce or raise the beta. That is not the thought process that we have in our investment process at all. And we continue to remain fully invested. Of course, our thought process will always be to reallocate between stocks which look more expensive to stocks which look less expensive within the constraint of what can be bought in the portfolio. So we'll continue to do that. But to put it in a nutshell, there's no specific strategy to overcome the volatility. I would just say that while earnings growth has been good for the current quarter, keep in mind that the longer the rates stay higher, in fact, it will be more problematic for smaller companies, both in terms of access to capital and their own cost of capital as compared to their larger brethren.
Yeah, thanks, Vetri. So there are a couple of questions on sectors. So I will take these to Karthikraj. So Karthikraj, there's a question on FMCG. So there has been a decent recovery in the performance of FMCG as a sector over the past year. However, the Mastershare Fund has a significant underweight position in the sector. So what is the rationale behind that, and your views on the sector?
Yeah, Niraj. So FMCG, if we see, even within the sector, there has been divergent performance even on a year basis. Even some food companies have done well, extremely well, while others have not done well. And even in HPC, this situation is similar. This is purely from a stock price performance. But from a fundamental perspective, like I said, I mean, the issue is that the growth over the last 5 or 10 years has been lower in single digit. And the valuations have inched up during this phase. They more than doubled in many cases. So to that extent, the valuation comfort is low, while the growth versus expectations has actually been lower. And even in the near term, if we see the weaker section and rural as a segment is yet to fully recover post-COVID. So overall, we are not seeing very strong growth outlook for the sector. While these are great companies, very high on ROCs and cash flows and competitive advantage, many of them have very strong competitive advantage. But the factor is each individual company will have to evaluate on the growth rate that they are able to deliver and the kind of valuations that they are quoting at. So in that consideration, like I mentioned, we are finding more opportunity on the durables and the retail side than in pure FMCG, and that's where we've continued to be underweight here.
Sure, Karthik, thanks for that. The next question is on IT sector. IT services sectors in general has not done in terms of well in terms of the earnings estimate in the last quarter, right? So, but analysts again they have also slashed the revenue growth guidance for the current fiscal as well. So, what are the catalysts hindering the sector's growth outlook?
From a medium-term perspective, IT sector clearly has growth legs. I mean, the cloud migration is definitely likely to happen. Digital transformation is likely to happen. Probably AI helps and brings in productivity as well. So overall, sector after sector, whether it is BFSI, telecom, retail, manufacturing, all companies are clearly investing in technology, and to that extent, the IT services opportunity is here to stay. But on the other hand, what you said is also true. In the last 1 or 2 quarters, the actual growth has been lower than expectations, and there have been some earnings cut. Probably this could continue for a few more quarters. It is very difficult for us to exactly pinpoint when the outlook changes. But what we read through is, one, like I mentioned, the valuations are no more punchy after the time correction and the absolute correction that we've seen in the last year and a half. And from a order book perspective, most of these companies are getting very good order books. So it's a case of clients actually delaying their decision, but not necessarily completely staying away or withdrawing from the IT spends. To that extent, eventually they'll come back, and we believe they're good cash flow generating and wealth generating companies in the sector. So that's where we have increased our weight here.
Yeah, thanks, Karthik. So we are already crossed the scheduled time of 1 hour. So in the interest of time, we will take one last question. So Vetri, this is the last question to you, and perhaps you can conclude the webinar for the day after this. So while the performance of equity markets over the last year have been highly divergent across the market caps, sectors, and even at the valuation spectrum of stocks, it has actually put the investors on spot, as they may lose sight on the potential winners in the midst of heightened ambiguity, right? So what's your advice to investors on this backdrop?
Vetri, you're on mute, actually.
Yeah. Sorry, Niranjan, can you repeat that last part? I didn't catch it.
So what we have seen is actually the returns have been very divergent across the market cap, sectors, and even at the valuation spectrum of the stocks in the past 1 year. So which has actually put the investors in the spot as they actually lose sight on the potential winners in the midst of heightened ambiguity. So what is your advice to investors on this backdrop?
Okay. Yeah, so I think, we have to learn as investors to both look at the data with a long-term perspective, as well as react to our investment decisions with a more, longer-term perspective. So, yeah, I mean, if you look at the last 1 year data, small caps may have done better than large caps. But actually, if you look at the last 5 year data, the Nifty 50 has done better than the small cap index. So, it depends on which point you choose to look at. You can't just keep cutting and slicing the data every time to say this looks better than the other. One, I would say, look at valuations when you make an investment decision. The more the valuations are in your favor, that should be the preferred asset class to invest in. That should be the preferred subsector of the market to invest in. That should be the preferred market cap segment for you to invest in. So be guided by valuations. Eventually, what I find when I look at the index data over long-term periods is large cap, mid cap, small cap. At one point of time, one sub-segment of this market is in fourth gear. At the other time, the other sub-segment is in fourth gear. But once you start looking at 5 year, 10 year rolling returns, the gaps are all like 100 basis points, 150 basis points. That's all. And actually, the best risk-adjusted returns are in the mid-cap space among these three baskets. So use valuations to determine your allocation, and don't get distracted by what did better in the last 6 months or 1 year. I think that is just a gigantic distraction of everybody's time, energy, and effort. So that's my simple message. Look at valuations, not what has happened in the last 6 months. But yeah, I mean, thanks a lot, Niranjan, for your questions and hosting this today. Thanks to Karthik, who's also been here and described the investment strategy for Mastershare. Thank you to all you viewers for joining us, sending in your questions in advance, as well as those of you who sent in your questions on a live basis. The whole purpose of conducting this webinar on a monthly basis is to discuss our views with you, take your questions, and be able to address some of those questions and thoughts that you might have preemptively. So we always try and make sure that we are sort of structuring it in that direction. And thank you so much for joining us in today's event, and we look forward to connecting with you again in a month's time. Thank you, and have a great evening.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.